predicting instead of reacting. Reacting is easier because and people don't like it. They say कि नहीं नहीं दीपक क्या तुम इतना साला stock market करते हो? You don't even know when the market will go up. I don't know. If you think I know, don't give your money to me. All right.
Very good afternoon to everyone. I am Ankit Kanodia from SmartSync Services, a SEBI registered investment advisory firm. Welcome to the 7th episode of Mission Smile Investing Karwa, a new Mission Smile initiative where we invite veterans from the industry every month who have at least 2 decades of experience in the stock market and learn from their vast journey and experience. For those who are watching this for the first time, Mission Smile stands for Making New Stock Market Investors Learn It Through Engaging Research. Before we begin, I would request everyone to please keep yourself on mute and switch off the video so that we can have a seamless discussion and soak in all the wisdom. You may type in your questions on the chat box. We'll take all the questions at the end of the session. So let's begin. Today, our guest is Mr. Deepak Shenoy, the founder and CEO of Capital Mind. Deepak dons many hats. He's a fund manager, an entrepreneur, a techie, a passionate blogger, a financial market expert, and an indulgent father. He brings over 2 decades of experience in financial market, from stocks to bonds to options and algorithmic trading. He was one of the first people in India to start an algorithmic trading way back in 2009. He co-founded 2 startups, Agni Software and Money Yoga, before launching Capital Mind in 2010, a Bengaluru-based wealth advisory and portfolio management service. Deepak sir, I just want to mention here, coincidentally, I am just 10 minutes away from your office right now, and we are having this online.
Indeed.
So he has written over 5,000 articles on topics ranging from personal finance, macroeconomy, stocks, bonds, derivatives, and public policies across his blogs. He has a BE in computer science from NITK Surathkal, and in his spare time keeps in touch with his programming background. He's a regular commentator on various media channels like CNBC TV18, CNBC Awaaz, and ET Now. Deepak, thank you so much for agreeing to do this. We'll start with an opening remark from your side and then straight away move to the Q&A. Deepak, you are muted. You have to. Yeah, you can start now.
Cool. Hey, thanks. It's been an interesting time. Coming through all of this. I wish you all the best. I hope all your viewers get to see everything that's happening in the markets, and we'll go through the questions. I think there'll be more context that comes out of it. Looking forward.
Sure. Thank you so much. So let's start from the beginning. In my research, I found that your first notable investment was in a technology-based mutual fund at the height of Y2K mania in 2000. Tell us a little background of that story as to what was going through your mind while you invested. And then when you saw your investment getting marked down by 80%, how you felt and what you did, and eventually what lessons you learned from that episode.
So, if you ask me, there is actually not so much of, the context around this purchase was basically FOMO at the time. And this was 2000 Feb, everything in the markets was going up like crazy. I don't know if anybody remembers that time, but that was, a different degree. I think stocks were doubling every 3-4 days. And, even when some of these IT companies would announce a dividend, they would go up 40-50%. So it was a crazy time. And then that's when, we were like, okay, why am I out of this? Because I have to be somehow in this. So we said, okay, let's go. At that time, there was no online purchase of anything. You have to stand in line, fill a form, give a check. So it gave a check, filled a form, went and did this thing. I think it was ICICI Tech Fund. So it was an NFO. That too, it was not even like a actually available fund. So you gave your money and then you waited till it got, this thing. So by the time it came about, I think it started only with some 5% down, and in the next 6 to 8 months, it went down 80%. So I was lucky because I had a very small amount of money in it. Um, and but that was all I had. So all my savings that I said, okay, let's go and see what happens. And we saw it fall, and the whole market fell. So it was not just the stock that thing, but the tech part of the market fell a lot more. So what was tech was down 80%. In fact, I think Wipro today is even now lower than its price in Feb 2000 today. So this is 22 years. So it has taken I mean, the stocks took a tremendous amount of beating. So the fund was down. At that time, you had, I think, you had an exit load also. So I had to wait for that exit load to get over. And I said, okay, chalta hai. So 10,000 became 2,000. It took about 4 years for it to come back to 10,000, at which time I said, okay, bahut ho gaya, let's go. I never doubled down, but I didn't have any money. So I was like more interested. Then I said, actually, that prompted me to go and find stocks. So in 2002, I started investing in stocks as well. So um, that was when the first set of early investments started to come in. They did really well. One of my first buys was Reliance. I still hold it. It's a long kind of it's gone through a long story since then. But what's important is, of course, at that time everything was available really cheap. Everything. 10p was the norm. 10p was the market. So you were getting stocks at 10 times earnings, good stocks, growing stocks at 10 times earnings. IT companies also, many of these IT companies didn't do bad. They did badly on the stock price, but the business was really good. So you got some really good entry points as well. So very interesting because you see all the ups and downs at the same time.
Sure. So, and I'm sure just like most investors, the early days of your investing would be filled with some wrongly borrowed false notions of investing. Maybe you would have picked them from somewhere or someone which you over the years discarded when you got your own experience. Can you list the top one or two of them, as that will help our community a lot?
I think you're pretty much most of your commonly held knowledge is like that. It's not complicated. Like, oh, you buy for the long term. Why should you buy for the long term? You buy whether it's long term or short term. How does it matter? Whether stock goes up in 6 months or stock goes up in 5 years, and gives you the same return, which is better. Obviously, the 6 month mover is a better thing. So price is not. I mean, your time frame should not be pre-decided when you get into a stock. You deal with it when it comes. So the other one is don't predict, react. I say that all the time. Everybody focuses on predicting kahan jayega, kidhar. Like jane do, then you decide where you're going. So you're basically the problem with a lot of us is we don't like failure. And in the stock markets, you will have a lot of failures. Everything you decide is based on some data. That data could be wrong, that data could be incorrect, incomplete, or in general, the data can be invented to suit a purpose. And that inventing data to suit a purpose is not new, it's there worldwide. So the issue that we have when it comes to stock market movements is that you can't predict them. uh, because even the best predictor of earnings, who got earnings exactly right this time, for instance, great earnings, stock goes down 8%. There is no predicting how the stock market will react, even to if you predicted earnings properly. So there's no point predicting what will happen to a stock price. You can at best try to predict that this guy will do well in his job and he'll be able to turn around the company in 3 4 years, and hopefully then the market will recognize it. There are lots of times when the market doesn't recognize it, doesn't care. So if a company had been bought in 2018, was doing really well in 2020, with COVID it also went down. Then even if it was a bad company, after COVID it went back up. So you bought it. So interestingly, I think the lessons that you learn in general from books, um, you should not follow them per se. Buy and hold, don't trade, don't sell, or only look at the fundamentals of the company. Price also is a great indicator. Why are you afraid of looking at price and walking? So for me now, price is a very big indicator of what is happening with the company. If a company falls 30% or 50%, is it because market ko kuch nahi pata hai? It's actually more because market knows something and you have to figure out what it is that you don't know more than anything else. Last bit I think is, your ability to participate in markets has only one rule. And Larry Hite, he was interviewed in one of the Markets Wizards book. Um, he said it best. He said it like, uh, if you don't bet, you won't win. And if you lose all your chips, you can't bet. There's simple two rules. Don't lose all your money. And don't be afraid of making a trade because of whatever reason that you have and all this. So the idea being you will not be able to select great companies all the time. You will have some duds in your portfolio. It's fine. Chase the winners. Get rid of the losers. Over time, some losers will come back. That's okay. But most of the time, your winners will be the ones that will give you the maximum return among all of the stocks in your portfolio, and they'll be the same winners. It will be the same stocks that will give you fantastic returns year over year, and some stocks will not give you anything at all. So you have to just stick with the winners and get rid of the losers. So that's the lessons I've learned, and I think mostly we figure this out over time.
So that's a very good point. I just have a follow up on this, Deepak. So if you can see, as in we at SmartSync Services also believe in this philosophy of don't predict, prepare. Rather than saying react, we say that prepare. And what we do over here is that we don't try to take a call on valuation. We invest in 20 long-term compounders, and then we let them compound, and we buy in an SIP form. And it is exactly the same philosophy where we see that 2 years, 3 years, 4 years down the line, your winners will actually show in your portfolio, and the stock which will not perform will again show. It will go down the price. The market will obviously market has its own wisdom, and it will show in the stock price as well. So, do you have any take on that as to if anyone, any new investor who is going to start his journey today and say want and has a decent amount of cash flows through his own say job or business, and if would you advise him to follow that strategy of investing through SIP in stocks? I'm not talking about mutual funds here.
No, the short answer is no. If a guy is new, क्या करेगा वो? It's just nonsense to say कि jump in and start doing everything from. You start with your mutual fund journey, start with index funds, keep your basic, because you have to advise means you have to give people proper advice. This is not an education. This is not like, अच्छा ये try करते हैं. This is
Right.
people's hard-earned money. Mostly they don't care about investing it so much in the sense they want the money to grow. They don't know how. So you educate them on boss, you invest, then things will go up and down. Don't worry.
Right.
Building portfolios is a different exercise. It's a more advanced exercise. So building portfolios. Now, I would tell people invest in index funds. It's very simple. Invest in index funds. Keep investing in index funds. Simple. No complication. The minute you graduate from there to active mutual funds, now you have to make analysis. कौन सा mutual fund अच्छा है, कौन सा नहीं है. That requires some work. Again, that work is largely being done by a lot of people, and they come out with their own set of advices on top. You can listen to that, or you can do your own work. So that becomes the next step. Then the third step, I would say, once you get past all of this, is when you start thinking of investing directly in stocks. Investing directly in stocks is not about investing in stocks. It's actually about building portfolios. Building portfolios is a very different thing from buying stocks. Buying stocks means you just keep looking. Some friend will tell you some stock, you go and buy it, you analyze it, you look at the fundamentals and all. I like this. When you build a portfolio, you're actually saying, I want these set of stocks meeting these rules in our portfolio. Uh, so I think one of the problems that we are having in the overall sequence of things is that people don't build portfolios. They want stocks. अच्छा stock बताओ type. So portfolios are like this. Your good stock should have a reasonable weightage in your portfolio. Your largest stock should have high weightage in the portfolio. You should have a philosophy that says, well, I mean, like for instance, if momentum is your philosophy, then momentum is the philosophy. You should have stocks which have momentum. If they don't have momentum, why are they in the portfolio? So you can have that. Then you can have models around how So this is a different topic. It's very boring. This is like, how do you make a dosa? The problem is not in making the dosa, because making the dosa is 5 minutes. It's in the batter. the power of how good the dosa comes out is not in the frying of the dosa, it is in the batter. And the batter is boring. They'll say, अच्छा इतना करो, थोड़ा सा salt डालो, थोड़ा पानी डालो, थोड़ा ये करो, थोड़ा it's too watery, it's not good, it's too this, it's not good, you have to do this when you. All that is very boring. No, people want to fry the dosa. They want to put the dosa and do truck and take it out. That is the most boring part of the dosa. That is the most interesting part of the dosa, but it's the least effective. The selecting of stocks is also the most interesting part, where people say अच्छा ऐसा stock, ये stock अच्छा है, वो stock. That is not how you make money. If you want to select stocks and show off to your friends, that is what you should do. But if you want to actually build portfolios and wealth for the long term, then you should build portfolios, which is basically finding a set of stocks. Now, whether 20 works for you or 100 works for you, all is fine. According to me, I have to have your philosophy clear in what you need to, what you want to do. If you're happy with 100, do 100. Peter Lynch had 1,000. Buffett has 600. It doesn't matter. And there's no hard and fast rule that only 20 होना चाहिए, only 25 होना चाहिए. तुम्हारी मर्जी है. If you want to do 50, you do 50. You want to do 20, you do 20. You want to do core and satellite, you do 20 core, 20 satellite. So in the end, only 15, 20 stocks, even in Peter Lynch's portfolio, about 20 or 40 stocks roughly were about 75% of his portfolio. That is the how the portfolios are. They evolve and they become concentrated on a few stocks that do really well. So I would say someone who's starting off now should not invest in stocks. They will not have any expertise in doing that. You take some money, it's a sandbox, it's play money. You use play money to build your strategy, to understand what works for you. Over time, when you get good at it, then you can move money out of your mutual funds into your stock portfolios. Till then, don't do it. It's like saying, I will, the minute I start uh, thinking of driving a car, I have to first learn how to drive the car. Then I can, yeah, drive a fancy car or a good car or this thing. So you're not going to go and say, if I'm learning, I'm going to go buy the most expensive car in the world. I'm going to buy cars that are, you know, uh, so for instance, if I want to teach my son driving when he becomes 18, I will teach him on a older car because I'm afraid, if he does something and all that stuff. But to give him a new car when he starts off would be a little bit dangerous, right? So the same thing I would say, don't advise people to, I won't advise people to just jump into stocks. It's a complicated thing. In the book that I've written, Money Wise, I've actually talked about it. I said it's like a progression. You have to start from the basics and then figure out where your interests lie and then go on to the more advanced.
Very well said, and completely agree with you. Actually, I should I should have framed my question better, but maybe that is for some other day. Moving on, I want to know more about Capital Mind. So we all know that Capital Mind was a completely bootstrapped startup. I think I read somewhere, I don't recall exactly where, maybe in in one of your tweets, where you said that if one thing you could change from the past about Capital Mind, it would be that you would have probably raised some capital and lived life more easily than worrying about monthly bills all the time in the initial years. There are two reasons I ask you this. Firstly, I want you to share your personal story on this, and I'll come to the second question later.
Okay. So no, I think I didn't mention it in just the context of capital. It was startups in general. So I think raising capital is important because you then don't have to worry about money while you're building the startup. You can, focus on the business. Otherwise, you're focusing all the time on, oh, अच्छा collection नहीं है, पैसा कहाँ पे है, can I get this, can I get that. So getting your capital right, capital structure right is an important part of startups, and it's not something that I knew beforehand. I learned it on the fly. Most people have two choices. Okay, either you raise money from an external investor or you take a loan from your parents, friends, family, equity from your friends, loans, family, and or you can go to a bank. This is the forms are equity and debt financing, and honestly, I never used either one. Never cultivated relationships with banks for debt financing, and I never took on any serious amount of equity financing, which was stressful when the business went through stress because all businesses go through stress. Right now, a lot of businesses look at what you're hearing in the startup space. Oh, अच्छा layoff हो रहा है, ये हो रहा है. Or what is the problem? The problem isn't that they don't have money. A lot of these startups are cash rich beyond a certain extreme, beyond an extreme. But the important point of doing some watching how they perform is that you will actually see, and I won't say that this is always the case, but you will always see that they get conservative when the markets start to come down, and even if they have cash, they start firing the people. So it's introduced a little bit of stress in them, even if they're funded. But the thing is, the availability of funding allows you to grow even in a good time without having to worry about salaries. So in good times, you don't have to worry too much about whether you'll be able to make payroll or not and all that stuff. And to me, that was a pain because in 2002, 2003, when things were bad, I was struggling for financing at the end of the month. Every month. So every month they would be like, "Oh, let's call this customer. He hasn't paid for a while. So let's see if he'll make a payment." And people are also, because it was a difficult market, so they would be like, "Oh, instead of 3 months, can you give me 6 months to pay?" So I would be like, "Fine, ab kar lo, matlab whatever is the thing." And then we'd call them up and say, "Sir, it's too much. Can you give us some?" Even big companies would hold off payments to us, saying that you guys are small, you guys somehow manage, yeah, we'll pay you eventually. Big invoices take some time. B2B is a very different beast than B2C. B2C, you get the money upfront, typically. Any B2C product, people pay you before they get the service or before they get the product also. They're willing to pay. B2B is the opposite. You do the work for them, then you get a 3 month or 4 month credit period. Only after that you get paid. So you have to manage your life between that. So we were a huge B2B company at that time in 2002, 2003. So largely our businesses, our customers had to pay us before we got cash flows. So now I would say it's funding is much more easily available. That time it was more difficult. Now it's like you can, if VC won't fund you, then angel groups will fund you, then individuals will fund you, your friends will fund you. They're all understanding of how the equity ecosystem works. And over time, you can either return their money or give them shares in your company, which allow them to participate in the long term glory of the company. I've even given money to startups who have returned the money back. And for the most part, now I don't invest in startups, but the one of the things that I do track very closely is how startups do after they've taken funding from external sources to understand how the model works. So right now, I would say it's a great time to have been funded already, but it's not great if your VC is on your case saying अब कुछ करो तुम लोग इसको मतलब lay off or reduce your costs or increase your revenues. It's not a great time to do that. You want a VC who's understanding of the business cycle and says, let's lay low for a couple of years, let's not push it. And then by next year or next to next year, when things start moving in back, we will then use the cash to really push, really higher, really increase sales growth and all that. But VCs have their own problems also. You can't just say कि अच्छा कर लो मतलब then तो आदमी बैठ जाएगा. So that is the other problem that VCs have on that part of the model. But I think in general the cons are less than the pros. So the pros is that you get less stressed when things go wrong. Plus, you have availability of capital. Now, people who've given you money, VC, they'll give you a bridge loan also, bridge funding also, in case you need like small amount, like 2-3 crores to just tide over 3-4 months. They have the ability to do that. If you don't fund it, you don't have any source of such capital. And when times are bad, nobody wants to fund you.
So moving on the same point, I have a second question now. So I would also want you to share your views on two models. So in terms of broking business, if we see, there is one which is Zerodha, completely bootstrap, profitable, and the other is say Grow, which is VC funded, fast growing. And the general disdain I see for the new age startups that got listed last year. I would be interested in picking your brains here. Do you agree with the consensus that these businesses have no or maybe very little intrinsic value compared to the market cap they trade at today? Or do you think otherwise?
No, it always seems like that. Why would you pay so much for this? So why would you, when Bajaj Finance was going up, people were asking that all the time. इतना सा तो है, lender है. How are you paying so much? You would say the same thing of a lot of companies that have gone from small to big. And those small to big, I mean, why, for instance, should a Tata consumer be priced at this level? Nothing, no other consumer business in the world seems to trade at this kind of valuation. Why should a retail business like DMart have this kind of valuation? So that those kind of questions will always remain. And Sometimes the businesses justify their valuation by growing into the valuation when they grow, or in other cases, the business don't, and the stock price is correct. So whether it was a GMR Infra, which corrected 80-90%, or a Suzlon, there's a lot of promise when you started off, but then the delivery and execution was not good. So they brought it down. GMR still has India's largest airport, I think. And yet the stock is floundering. It's at way about 70% below its IPO price even today. So it's not that the businesses that we talk about, the new age businesses and all that, are all going to be duds. They maybe have been higher and aggressively priced because of valuation, but I would say in general that they can grow into their valuation by building up the business now. Zerodha is a phenomenal example of a business that is not listed, that does not need external capital, and is a fantastic money spinner because it produces real profits. They do real buybacks, they pay real money, I mean, to people. So it's not like this is invented cash. Versus some of the funded startups may actually have problems in bad time now, because one of the things is that even businesses, if you see the balance sheets of almost all the brokers, uh, I think Angel, ICICI, and Zerodha are all profitable, but the others are not in the top five. So the issues with those are, I think their cash burn is very high because they have to be. They're not pure play brokers. The broking is one part of a larger division of things. They have a mutual fund distribution, they have something else, or something else. So they have some lending arm, they have this, that. So all of these businesses put together are losing money. And each business individually may actually be, some of them may be actually generating positive cash flow, but they may actually have negative profits for accounting reasons. So over time, you will, I mean, I personally find the bootstrap model. We have bootstrapped almost all of what we've done is bootstrap, but we did require some external funding. So the founders put in the money, but in general, I would say uh, pursue a model that suits you. If you want to really scale and you need the money, then क्या करोगे? You might as well take the venture capital. How can you set up an Uber today in India without funding? It's impossible because you have to incentivize the drivers to come to your platform. You have to incentivize the customers to come to your platform. If you try to make a profit in all of this, you're finished. So you're going to need at least 1 or 2 years of loss making just to get to the business. After that is when your business becomes a proper business and you can try to make it profitable. Sometimes it's so bad that there's so much competition that nobody can make it profitable. Today, if Ola raises price or Uber raises prices by 30% and increases the take rate from drivers from 30% to 40%, then they will make money, sure. But I will not travel with that Uber because it's too expensive. Maybe a lot of people will not. The drivers will say, Ki boss, first of all, I'm not getting Savari. On top of that, you're taking 40% instead of 30%. What's the point? So this, I think, is a fundamental disconnect between between for businesses that are purely burn businesses, whose only idea is to generate market share without profit, and profitable businesses like Zerodha, where your volumes will just increase the amount of profits you make. But even if the volumes fall, you'll still be profitable at a lower level. Uh, uh, I say eventually all businesses have to become like Zerodha. Whether you initially start off being funded, whatever, even Amazon was funded, right? So it eventually became a cash machine. The cash machine part is important. So if you don't become a cash machine, then you're going to struggle for a long time.
Right, right. So I'll go back to again your favorite quote, which is "Don't predict, react." And it does sound to be a very intriguing and powerful concept. I would now ask you to probably deep dive into it and help us understand how it has helped you in your investing framework, in terms of your portfolio allocation, building your portfolio. And if you can share some examples, that would be really great.
Yeah, so I think don't predict, react is simply this. Um, Instead of trying to say ki, what is the impact of something, you might want to predict. Russia has attacked Ukraine, market is going to fall. You may be right also, but in 6 months later, you may be wrong. Because the market, after going down, will come back up also. It can come back up to a point where you think, Acha, Russia is still attacking Ukraine. The war is still going on, but yet we are now at all-time highs or close to all-time highs. So this disconnect is because you try to predict and assume your prediction was correct. They say, no, the company missed estimates. The company didn't miss anything. The analysts' estimates were wrong. It is essentially that. That means that if your business intrinsically is not predictable, and most businesses are not, because some businesses you can predict, people will keep smoking cigarettes, so certain cigarette companies will always make a certain amount of profit. वो तो given है. But even in that, in COVID, what happened? You had lockdowns. People could not buy cigarettes even if they wanted to. And then the sales of cigarettes would have come down, regardless of whether they liked it or not. And once you become a bigger business than just the cigarette business, you'll have an FMCG business, on hotel business, on paper business, then it becomes even more difficult to predict. So therefore, predicting based on, and what are you trying to predict? You can predict at some point that earnings will increase. Okay. Does that mean the stock price will increase? No. It doesn't mean anything of that sort. It doesn't mean that stock price will not, because it could be that you're saying, no, earnings will grow up in 5 years, so the stock price will be greater in 5 years. Yes, fine, but will it be greater than inflation? Inflation will be 5% a year. So minimum 25, 20, 30%. So you have to go to 30% just to beat inflation. That means 100 rupees today we have to become 130. Can you predict that? I don't think so. Nobody can. So it's better to say, okay, I don't think I know what's going to happen when I don't know if it'll go to 130 or not. But all I can tell you is to go to 130, I have to see it go to 105, then 110, then 115. So maybe at each time, I still see a long way ahead for my 130, 140, which I can't predict, but I'm just saying that over longer terms, if I have to beat inflation, then I have to select a set of companies. I will watch them and say that when it becomes 105, I want to add a little more. When it becomes 110, I want to add a little more. So that's how you construct portfolios also. Think, what are you going to do if something happens? That if something is best, according to me, on price, because price is a reliable indicator of everything. It's a reliable indicator of value in the sense of, it's not a reliable, so it's a reliable indicator of what value people perceive in a company today. You may perceive a different value. That's why you're a buyer. And so somebody is perceived a different value, that's why they're a seller. Your time frame will be different, the seller's time frame will be different. You can't predict what the other person is saying. But what I can tell you is the prices are reliable. If you're seeing a downtrend in prices, then something is wrong with the company, or there's something fundamental happening, or even non-fundamental, not related to the company. Some external investor wants to sell his shares. His shares have come out of lock-in. He's selling, regardless of whether the company is a good company or not. We've seen this many times where share prices have fallen simply because people sell without a proper fundamental reason. Like they don't think the business is doing badly, but they just want to sell because they have to sell because of other reasons. So given that you cannot predict what will happen, you therefore should react to what is happening right now. It's not even react to what people think will happen tomorrow. You say, hone do. Now, last 15 days, you saw hundreds of articles. LTCG will be increased by 10%. Stock price will be, so all this drama. Yesterday somebody came to my room and we were talking about this and he said, nahi, LTCG to increase hoga na is saal. I said, how do you know? It's February, we're in November. So he's like, no, this article said they seemed very confident. I said, very good. Let me see the money. Let me see the actual fine print of what happens. And then I will make my decision. Making a decision in November, thinking that in February the government will increase tax, sounds completely zany, right? It's waste of time. So you're predicting instead of reacting. Reacting is easier because and people don't like it. They say कि नहीं Deepak क्या तुम इतना साला stock market करते हो? You don't even know when the market will go up. I don't know. If you think I know, don't give your money to me. Wave, I want to write 80% of it. I don't want to write 100% of it. You guys want to find bottoms, tops, all that stuff. You guys do. They're more intelligent than me. I am not that intelligent. I just say the market will show me direction. We will see. If I see earnings trend, I will go. If I see price trend, I will go. I like to see numbers go up and to the right. But they have to go up and to the right. It will not be like my prediction. They'll go up to the right. All I can say is my prediction stops at if they're going up, they will keep going up. By and large, that is the answer to things that when a batsman is in form, he does well. And a batsman is in form because he's doing well. So it's a cyclical argument, because the confidence a company gets when a person gets when he's batting well makes him do well in the next, because confidence is 50% of the game is all in the mind, right? And the same thing in stock markets. If companies stock price is falling, even if it's the best company, even if it's HDFC Bank, people ask something is wrong. The management is not good. People are leaving. What is happening? They think of falling stock price, and it's the other way. So when the stock price is going up, people think this is something a really good company. So if there is a person who's trying to make a business with two banks and one stock price is going down, one stock price is going up, he'll find the company whose stock price is going up and say, "Usse karta hu yaar, at least he'll be okay." So this is the concept of no don't predict react, is that you have lots of enjoyment and fun in predicting. Our whole life is like that. Okay, we predict all the time, but leave it as entertainment. The actual money making is in reacting to stock prices and hoping that over time you don't lose too much money by entering too late or getting out late, because you'll always get out late, right? So if you wait too long, you can end up making significant losses, even if you react. So that is one risk. But otherwise, I would say by and large, I think this works in everything in my life. I have kids also. I have no idea. I can't predict what they're thinking today versus what they're going to think tomorrow. So we don't predict. वो जो करना है करो. And में जब when the time decision comes, when I have to make a decision whether you can do this or not, I will make that decision. I cannot predict what the outcome of a match will be if I'm watching it, or outcome of a movie will be when I'm watching it. All I can tell you is that I can tell you what my reaction to it will be, after I see what it is. So if I'm watching a movie, there's a lot of violence in the movie. When my kids were young, we'd switch off the TV. I cannot predict in the beginning, because some movies also say, "Oh, this is okay for kids," especially in Hindi movies. You see a lot of violence in the Hindi movies also, and then you say, "Nahi, usko band karo. Nahi, I don't want my kids to see this." So that's a reaction. It's not a prediction. At best, people try to make your life easier by putting a rating, dalte hain, PG and whatever and all that stuff. But in general, these warnings are also outdated. I would actually, in a lot of cases, it makes no sense. But there are movies where bad language is used and it's perfectly acceptable compared to violence. But we don't seem to care about that. The dishum dishum is fine, but the bad words are not fine. Sounds, counterintuitive to me, because I would rather because words are words, kya hoga usme, but this violence funda is not a good thing. At least for small kids to see. And even our cartoons are like that. They're so violent sometimes. Some of Indian cartoons. Even Tom and Jerry is violent, undoubtedly. But it's relatively isolated violent kind of thing. In India's many of the cartoons that come, there's actual, human beings violent wala situation. But okay, that's me digressing. But still, the point over here is prediction in general is a waste of time. I predict once a year on Diwali, and next year I go back and say, "मैंने क्या predict किया था?" and how bad I got it wrong. Usually I get it wrong. 50-50 hota hai, which means it's waste. Predict now, don't predict is the same thing. But I have proved it since 2008, 2007. I've been writing this. So it's been what, 15 years now. So 15 years of writing this is where I have got to a point where I feel that my own track record tells me it's a waste to predict anything. Once in a while, you'll get a prediction right.
I have a follow-up here. Since you're talking about reacting to the situation or reacting to the price, just taking an example, I hope you are comfortable. Let me know if you don't want to discuss this. So, say for example, Bajaj Finance, theoretically or hypothetically speaking, say if you'd have bought Bajaj Finance in 2011-12, by whether your analysis or through some luck or something like that, and if you follow this philosophy of don't predict, prepare, since then till now, Bajaj Finance stock has corrected 50% from its top, I think about 3 times. So how do you react?
You sell and then you buy it back when it goes back up. What is the big deal? The
Okay, so
point
you're
is, we don't like to do that. What's wrong
right.
with selling? And how many stocks are there which fall 50%, then fall another 50%? Maybe
Right.
thousands of such stocks. One Bajaj Finance.
Right.
So I mean, it's useless to say one stock should be the reason why I should not sell and all that. Sell, it comes back up, you buy. What is there? You're reacting, you're not predicting. So if it's
That
down
made it more
30%,
clear.
you sell.
Yeah.
It's up 30%. I mean, it goes and comes back to the new high, you buy. So what? You lost 30% in the middle of the gains that you could have made. But so what? I mean, you still couldn't be immensely profitable. In that time, you might have found another stock that's doing really well, and that gives you the ability to write that other stock. And then until Bajaj Finance becomes a solid, position, you can keep it as. I mean, I wanted to buy it. I'll buy it when the time comes. Building portfolios is that you don't care about the individual stocks. You just want to make sure this is a well-rounded portfolio of a certain type. It's diversified, it's got a bunch of things and all that. So I think it's, this is counterintuitive, but don't be afraid of selling and the stock going up. If it goes back up to a point where you feel like you got out at minus 30% from the top, that minus 30% from the top can actually be plus 200% from the time you bought it. So it could have gone up 300% and then fallen up to 200% only, which means you're still making money. You're just making less money than you did when you were at the top. So get out, goes back to the top, buy it again. What is there? It's not rocket science. And honestly, this funda of I won't buy because I bought at lower price, I sold at lower price. Well, keep that outside the door when you're getting into an investing framework. Investing में you should not anchor yourself to your last purchase of a stock. क्या फर्क पड़ता है? The fact that you bought a stock at 100 and now it's at 500 makes no difference. The company's business will go on whether you bought it at 500 or bought it at 100. If the business is worth 100, then it's worth 100. So it's worth 500, it's worth 500. The fact that you can't deal with it has no bearing on the business itself. So you should throw that out the door and say stock goes down, goes back up, buy again. It's fine.
That's a fantastic point because if I got the learning correct over here is that uh, एक बजाज फाइनेंस 50% गिर के वापस बढ़ सकता है बट मे बी देयर विल बी थाउजेंड्स ऑफ स्टॉक्स व्हिच विल fall more than their first 50% drop, right? So you in a way also cap your downside. So that is how it works well from the
Yeah, look,
perspective
I
of
told you Wipro is down the same level as 2000. It's
right.
broken out once. Now, that once was last year. It broke out to double. Then it's come back to below. It's at 50% below the price that it was 1 year ago. So, uh, at what point will you say Wipro is a good company or a bad company? I don't know. Maybe it's a good company. Maybe it's a bad company. You would listen to the price. The price, that is one way. Other one is you listen to the business. Steel cycle hai. Steel cycle khatam ho gaya. You're getting the view that the steel cycle is over, that supply is coming to the market, the prices are flattening. Stock prices are still high. You get out. The business is, the cycle is done. Then you get back in when the cycle starts to renew. But you know that typical cycles take 2-3 years to come back. So you wait. So you don't want to get into those stocks at the wrong time. And you don't mind being wrong because the steel cycle will come back tomorrow also. We have no idea. But this steel cycle coming back is when the stock prices will start to go up again. And then when they make all new highs, they're not making new highs. Only guys making new highs today in comparison with others are public sector banks, railway stocks, some defense stocks. None of this is IT companies and all that. Very few IT companies are anywhere close to their highs. So given that you're getting a signal from the market that typically says, there is no momentum in those stocks. There's not enough people buying those stories. So that's why those stocks are depressed. You can buy them and wait. On the other hand, you can take the signal that says, okay, this is enough. I'll move my portfolio into defense or railways or something like that over time, because I think they're actually a set of stocks that have not moved at all for the last 10-15 years. And suddenly they're getting some impetus because the government is doing something. So then there's a fundamental change in the business. You want to take part in that business and says, okay, well, not only is there a fundamental change, the stock prices are also reacting on the upside. So I'm getting double confirmation here. Then I might as well use some of my money, even though I might buy some stocks at really high valuations. That might be still a good strategy to participate in a growing market, because what is high PE today could be low PE tomorrow simply because earnings go up.
Moving on to the next question. So we all know that you have applied for an AMC license, and there are several other players also who have applied for the same. And so I would be very interested to know, how do you see the AMC business evolving over the next decade?
So I think AMCs, we are an AMC, so I obviously like the business. But in general, AMCs in India, the mutual fund AMCs have been struggling because of lack of enough. So although their assets are growing, their amount they're able to charge their customers is reducing and reducing over time. That reduction is coming from a move from, say, actively managed funds to index funds. There's a reasonable move there, but it's also happening as a result of competition. Competition is able to do better returns because they charge lower fees. So you have to charge lower fees. So one is that these are the risks to the business. The third risk is people like us who come from the outside and start their businesses. The existing AMCs will have to compete with us. Now, at some point, we'll be too small to compete. So, but at some point, I could grow to a point where I'm big enough to compete and take away market share. And remember this: in the mutual fund world, half of the AUM in India is owned by rich people. Half of the AUM is owned by poor people. I'm talking individuals, not corporates. So that means rich people is people who have portfolios worth more than 2 lakh rupees. People who have portfolios worth more than 2 lakh rupees own half the funds. So if you focus your attentions in as an AMC only on the small guy, you're only attacking half the this thing, and your support costs are much more, because a person with 1,000 rupees invested also requires the same level of support as someone who's invested 1 lakh. So your ability to support and the cost of supporting on a per individual basis, because you have more individuals, is much higher. So businesses here that focus on profit will have a very strong mix between corporate rich HNI individuals and retail, and have separate ways and channels to monetize from all three of these. The problem right now is there's so much competition for this space, the rich people space, that some of the mutual funds are missing out on some of the relatively richer people's AUM because it goes to alternative sources like AIFs and other things. And also that their products aren't innovative enough for people to want to invest over the long term. That innovation can be is part of the system. It will come eventually, but I think that part of the system is something that SEBI is addressing very closely. We hope to get in and change some parts of the system, saying we will do it, but we will do it in a better way than everybody else, which is why we will also get some very tiny market share. Of course, in the absolute long term, I mean, I'm talking about like the 10-15 year period, AMCs are a cash cow because all their costs are borne by the unit holders of a fund. It's only the people like, it's only the costs that can change the game, are like management salaries and things like that. Apart from that, most costs are taken care of. So given that anything you make on higher AUM is just profit, so it's a very good business to run. There will be some short-term headwinds, that's all.
Uh, that was very, very, very helpful. So moving on to the next question. My next question would be, given the kind of passion you have for macros, how attracted you are to individual stock picking? Do you regularly read annual reports and con call transcripts? Why or why not?
So I think reading annual reports is rated, because it's okay to read it. It's not a bad thing, but not everything is presented in a format that can only be seen in an annual report. At best, annual reports are sketchy, and management washed discussions. So management only tell you good things. Oh, I will go and do this. I will do that. Of course you will do it. तो हर आदमी बोलता है, but करके दिखाओ. How many people do that? So you go back to 5 years ago ka annual report, find out what all he said he'll do, and can you go and figure out if he's done it? 99% of people who read annual reports also won't know this, because they will keep reading the current annual report and say, "Isme," but not going back and saying this is what the concept is. I think in the long term, macro works very well because it gives you an unhindered view. So right now, for instance, debt yields are high and coming down. I think even today the yields are much lower than they used to be even 3 weeks ago. The rupee is also, it had gone to 83, now it's 81.5. So why is this macro important? Why is this important for me to understand this in general? Is that it gives me a framework to understand what players are thinking and looking at. If interest rates are too high in the US, won't it affect how much inflows come to India? If it does affect those inflows that come to India, then how much will that impact our stock markets in general? This is was unpredictable right now to say how much domestic investors actually added to their portfolios so much money that it outstripped how much ever FIIs were taking out of India. This is the first time it's ever happened like that. Not predictable, but what you could predict is, we will see an exodus of funds. We thought about this last year and said, okay, there was roughly 150, 200,000 crores that came in during COVID, and that part of it will go out. Well, whatever came in during COVID, that much you could say. But how much does that impact the stock market could not be predicted. So at best, it gives you a framework to think and sometimes opportunities as well. So when interest rates were very low, a certain set of businesses made a lot of sense, especially in the West. People copied those businesses in India and put their names to it. No, whether it was offline or online doesn't matter, but they were copycats who built their businesses here. When interest rates go up in the US, some of those businesses are valued at much lower than 2 or 3 years ago. But the Indian counterparts are valued at the same as 2 years ago. And since those valuations haven't come down, so to that extent, there will always be something or the other that changes worldwide and eventually affects India. But you get an idea of saying, okay, this is exactly what's happening. For instance, right now we're predicting and that home sales in the US will come down. Now, it doesn't make any difference to our investing strategy today. But I do know that if home sales come down, that means there's a recessionary tendency in the US. That recessionary tendency means that there will be people buying less stuff if their house prices are low and they may have lost their jobs or whatever. There could be foreclosures in the US. This affects the BFSI industry. If all of those things are supposed going to happen, then we're going to see that the stock prices of some of these stocks will come down. The business updates of some of these companies will show that there's a negative impact on their revenues or higher impact on their expenditures and so on. That will translate to their suppliers, say in India or in any other part of the world, getting affected, because if you have to fire 50 people or 100 people, you're also firing some of the people that you outsource this work to. So that part of the business is an interesting point, because then you're saying, I'm going to work with what if scenarios. What if this happens and this happens? Then I need to make sure that I'm out. So for instance, if I think that my stocks, and we have a stock which makes tires that are sold in Europe. So to me, a European recession is a risk, is a key risk. But I am saying it's a risk. Doesn't mean that I know it will happen or where it will be bad for my company. It could be that the European manufacturers, who are the competitors, shut down. In which case, this guy who's from India suddenly gets lots of business. So I don't know the answer to what will happen. All I know is something will happen, and let me just figure out, based on a lot of these factors, which of these two scenarios is happening. Is the Indian company losing business, or are the competitors inside Europe going out of business, and therefore gives me an opportunity to continue this. So for this, I have to look at the European macro to understand where things stand and how their governments will respond, because government response is also interesting and important to how markets perform. To me, macro level investing gives me a greater framework to build an investment thesis. And today we formed an investment thesis around India, which is almost entirely, starting from the macro. And 2 years ago, I actually talked about this, and we had a podcast about it. I said, if the US was planning to print $5 trillion after COVID, I said, in this $5 trillion, because it makes its way around the banking system and eventually to hedge funds and investment funds, 1% of this money will come to India. 1% of such money always comes to India worldwide. 1% of $5 trillion is $50 billion. $50 billion is 3,75,000 crores. That time rupee was 75 to a dollar. So it was 3,75,000 crores. In 3 months, 2 lakh crores came just to Reliance. And then India got another 2 lakh crores over the course of the next year. So we got 4 lakh crores, which is almost exactly the amount that I said will happen. But I could not predict it will come to Reliance. I could not predict that it will come to how much it will come to the market, when it would come. All I knew that if you print so much money, some part of it will make its way to India. That's how the macro has. So we took a long bet at that time. We said, let's go to large caps because that's where the volumes are going to be. So we switched our investment strategy based on this macro assertion that this is going to happen. But we said we'll do it over time because as we see this money coming in, that is when we want to move more money in because we're going to react, not predict. So you work the thesis. You say, if this happens, I'm going to do this. You wait for that thing to happen and then do it. So we weren't early, but we didn't do it before all the money came in, but we did it early enough.
Very, very, very interesting. So moving on to the next question. So since we have some good stock pickers in the audience, I can't help but straight away ask one question directly related to the market. Which are the sectors you like at the moment and why? And which are the ones you would be cautious on or avoid today?
So
You
I
may
think
share
it's
us few stock
useless.
names if you want. Yeah.
No, it's useless. The stock names, sector names, usually, unless you're a short-term trader, and that too short-term, में क्या करोगे? You look at the price. No, whatever is doing well, you buy. That is the short-term strategy. Um, Longer term, we think a lot of sectors will do well, whether it's logistics or banking or some of the non-banking financial service companies. I think all of them have a lot of potential. Even the new age companies, although the stock prices are battered every day in the markets, but I think long term, some of them will actually succeed and succeed very, very hugely. So, given that opportunities exist in every space today, even in the weakest structure. In steel, there's a steel company that is actually has no debt, relatively profitable, makes certain product which has certain set of applications which are almost always in demand because they're the number one supplier in India or the highest supplier, biggest supplier in India. Given this entire structure, I can tell you that there's no single sector that I can tell you that I completely hate. Of course, I don't particularly like gambling. I think the money is usually siphoned off. So I don't like that particular sector. I don't like most of the FMCG sector. I think is ridiculously overpriced, and it's overpriced for a reason. They're good quality companies, but a lot of them I would not venture into buying for a long-term portfolio because it's not the right price. Um, but apart from that, I think a lot of sectors are easy game.
My point was related to long term only, and you have answered it really well. So moving on to the next question. So how important is networking with like-minded investors in your view? What are the advantages? And are there any pitfalls as well?
Yeah, you shouldn't network with like-minded investors. You should network with unlike-minded investors. Somebody else you meet, you like Reliance, he also likes Reliance. हाँ ठीक है हो गया ना फिर what is the point, right? You want somebody to meet you and say don't buy Reliance, then you say work with the guy. क्या कर लो ये you may not convince each other at the end of it, but you'll have a good argument, a good discussion, a good feeling, and you should meet people who do different forms. वो core fundamental होगा, he should go and meet one technical guy. The core technical guy should meet the fundamental guy. They will hate each other for a long time, but at least they'll get context. If you don't have context, then you can't invest. Because you'll always be sitting in a little cocoon. मैं तो बहुत पैसा बना रहा हूँ. Then one downturn will come and all of you lose money. Everybody loses, okay? Technical, fundamental, everybody lose money. So in the end, they will be like, Acha, I was earning so much money, what happened? Then they will go around looking for answers. And the answers will come from other people. One value investor will come and say, मैं तो पैसा बना रहा हूँ. Then you will think of him and say, I should move from my technical to value. But तुमको value का ABC नहीं पता है. So then you will say, okay, you will make stupid mistakes again. And then by the time you figure it out, value would have lost its mojo and technical will be back. And then you'll be like, shit, I was right. But this is the problem. Having these too many inputs is also a big problem. So you should meet people, you should enjoy your time with them, have reasonable debates, but always make your own decision. Don't listen to other people, get influenced and all that. That's what I said. We don't need gurus in the market. Nobody is a guru. Everybody is a student. They're all students of different degrees. My son goes to a school, or was going to a school before he was in fifth standard. They were actually doing 2, 3 classes combined. The second, third, and fourth were combined. Now, why is this combined? There are some kids in each section who are second standard, some kids who are third standard, some kids who are in fourth standard. Now, what happens here is in the second, third, and fourth, the early part of life, some second standard kids will get fourth standard mathematics. Some fourth standard kids will struggle even with second standard mathematics. Sometimes it is the second standard child teaching the fourth standard child what mathematics is. And the fourth standard child will go and teach the second standard child what biology is or what chemistry is. This is a eternal concept where everybody is a learner and everybody is a teacher. This is why you should network with people, because then it helps you learn and it helps you teach other people as well. And that in the process of that, we all learn. Now, to go in there and say, I will only network with like-minded people, I will only do this, that is nonsense. And for the most part, you'll get influenced too much if you meet a lot of people who are very successful and tell you some shit. It's like, Elon Musk tells you buy Dogecoin, you think, oh, Elon Musk तो बहुत rich है, मैं खरीदना चाहिए. नहीं, वो कौन सा मतलब क्या? What is this logic? It's just वो उसने टेस्ला बनाया है, Dogecoin किसी और ने वो जोक के लिए बनाया था. But you cannot listen to people just because they have a pedigree or a success. You make your own decisions. You're always the king of your own world. That means you get to make the decisions in your world. Nobody else gets to make that decision. So no mentor, no guru, all that. Everybody is a friend, and everybody is somebody from whom you can learn and to whom you can teach. As long as you have that mentality, I think you will succeed. Otherwise, you end up with a lot of disappointments. यार ये गुरु था, इसने बोला, मैंने किया, बर्बाद हो गया, whatever. That stuff should not be there. I think over time you will end up with this messy situation of loving or not loving things that other people do, and because you pay them too much respect. In India, we have this funda of you should give your guru respect. That everybody is a guru, then everybody should respect each other. It should not be one-way respect. I don't like people touching my leg for one reason. Why are you touching my leg? I'm not going to touch your leg. So why? So I'll give my respect to my elders who are older by age, and I'll respect their age. But I don't have to respect their knowledge forever if they don't respect mine. And the elders who respect the younger people's knowledge are the ones that get the most attention also, by the way. It's just the way it is. So I think networking is a double-edged sword, but you should use it right. You should use the right kind of networking. It's perfectly fine to be a person who does not network. Investing is a very lonely activity. Don't mingle with people just because you're feeling lonely. There are other ways. You can go rock climbing, you can go join a trek with other people. So many more enjoyable ways to mingle with other people. But you shouldn't mingle but you can mingle for the sake of saying, okay, let's go. I'll tell you, we have a bunch of WhatsApp groups. Sometimes we do these calls. Call में हर आदमी एक stock बोलता है. वो क्या फायदा है उसका? Because you get 500 stocks at the end of the day. All you know is you know a little bit more about each of those 500 stocks. Okay, इसमें फायदा सिर्फ ये है कि you may get that one little piece of knowledge that will help you tomorrow. It's not like you're going to buy any of these companies. Because everybody has limited time, they're only talking on one company. Each person has 100 companies in his portfolio, 20, 30, 40 companies in his portfolio. That is okay. They're talking about one today, they're choosing to talk to you about it. It is not an advice to you to buy that stock. If tomorrow in that WhatsApp group it said, मैंने बोला था ना ये stock, देखो ये double हो गया है, I will laugh at the guy because I'll be like, छोड़ो ना यार. Because what is the point? I know that particular stock was X. I am not going to give. I look at all conversations as learning exercises, and at best, in the end, I have to make my decision. I will not blindly follow anybody. I don't care enough to blindly follow anybody. So I think nobody should. As long as you don't blindly follow people, you will come out better, and we will have less regulations. ये regulator का चक्कर भी ये होता है, और ये तुम influencer हो, तुमको नहीं बोलना चाहिए, तुम advisor हो, तुम ऐसा नहीं करना चाहिए. Why? Because they think that people blindly follow advisors. If people said ki boss, I will take my own decision, I will be smart, then we will not need so much regulation, so much rules. You cannot write, please, you have to write at the end of every advertisement, please read the offer document carefully before investing. Now nobody listens to it because it's boring. Everybody talks the same, says the same word, right? It's like tobacco warnings for cigarettes. I don't know if it has helped, but I can tell you that 90% of the smokers I know ignore it, um, uh, because it is too much of it. If you did it once in a while, it would have had an impact. But the reason they do it, a lot of it is because people are they think people are gullible and they need a grandfather. So I'm saying, instead of me telling the regulator what to do, I'll tell you, don't require grandfathers to tell you what to do. You do it. You make your own decisions and be smarter about them.
Your this thing reminded me of that when you talked about there are no gurus, we are all students. It reminded me of that RJ favorite quote: "There are no kings in the market, and market is the king."
Yeah.
So
He's
yeah,
right.
so
He's a smart guy. He's also not a guru, but he's a smart guy.
exactly. So this is my favorite question, which I'm now going to ask you. So if you were to start investing with a very small capital of say 5 lakhs or 10 lakhs today, what would be your overall investment strategy? How will you go about it?
Me, I just put it in my PMS. So it's just the way it
Huh?
is. I would just put it into my PMS, but if that's the only money I had, then maybe
PMS में
it
तो
depends
25
on
लाख का वो है ना. You can't put
50
5
lakh.
lakh in
नहीं नहीं
PMS.
50 वो है, but then I'm assuming you have new 10 lakhs. 50 lakh already है types. But I would say right now what you would do in general is it depends on three things: your skill, your inclination, and your time. If you have all three, then you can build your own portfolios if you like. If you don't have anyone, go to mutual funds or index funds. That's all. That's what my core advice to anybody is. If you don't have the inclination, the skill, or the time, that means you should want to do something, you should know how to do that something, and you should have time to do that something. That something is investing, right? So, and investing is a skill that is learned. It's not an art. You're not born with an investing bone in your body, although people think they are. But to a very large extent, it's an art that is learned. I mean, the skill that is learned over time in the market, and you have to learn from failure. You have to learn from rules that you set up, and over time build yourself like portfolio. So if you have all three, take the 10 lakhs and then start looking at stocks, figuring out what it is. But I'm assuming that if you have only 10 lakhs at the first time you come into the market, you're going to be raw. So you might want to put half of the money into an index fund. The other half you do what you want. And then over 2-3 years compare. Index fund ने better किया कि मेरे 5 लाख ने better किया. So if you can't do better than an index fund, then give it to the index fund. No, let him do all the hard work. Why are you doing? If not, you're better, then take the money out of the index fund and invest in whatever you do. So by that time, you would have figured out your philosophy, how to build portfolios. You would have gone through an up cycle and a down cycle. And then you would have seen how your body reacts, because mostly your body reacts very violently. You start fighting with your family. When all these are very, I've gone through this cycle. So now I don't care. When I go home, I don't tell anybody that market is up or down. I don't care. I honestly don't remember what the market is by the time I've reached home. I'm very happy. The next day the market opens again. I don't watch SGX Nifty and overnight. I'll watch crypto sometimes just because it's so much fun. It's just like it's entertainment for me. I don't have any stakes in the game. तो मतलब 10% ऊपर 10% नीचे. It's like little filmy things that happen, and some dialogues will come. We are safe. 2 days later, one dialogue. No, we are not safe. We are bankrupt. ये सब मतलब this almost like it's like a Netflix series playing in front of you. That's why I like to watch it. But otherwise, business wise, it's like, oh, if tomorrow some news comes, some company has done bad result, I'll be like, हाँ ठीक है, कल सुबह देखते हैं. 9:15 को खुलेगा ना तब. What's the point of trying to react before that? At best, you can analyze the result and say, okay, this is good, this is bad, it's changed my philosophy, it's not changed my philosophy, and that's all. Beyond that, you can't do anything. You can't fret about it and worry and all that stuff. So you'll have to go through these emotions to learn them, because nobody teaches you this and nobody can teach you. It's like people, if they tell you, being a father is like this. When you are not a father, you don't understand, or not a mother. Mother even worse because people give you their gyan. Um, uh, but I think nobody understands until they go through the process how complex it is. So the same thing in, I don't even bother. Equity investing is like a life skill. It's like cycling. You cannot teach someone to cycle by telling them अच्छा pedal को ऐसे करने का, body को ऐसा balance करने का. नहीं, वो he has to learn by doing. So you do. And again, skill, inclination, time. If you have all three, do, learn, fall a little bit, get bruised, understand how it feels, then go forward. I think that's my philosophy in general. And I'm not saying this because I'm a PMS manager. It doesn't matter if you give me your money or give somebody else. The point is that if you don't have this, it's just tears in the end. It's not worth it.
I have a few more questions, but I think 2:30 is a hard stop today. So one last question before we open up for Q&A with the audience. So one last question I think I would ask will be about your book, Money Wise, Timeless Lessons on Building Wealth, was released last year. If I have to ask you to just sum it up in 2-3 sentences, what it would be, and I would also be interested in knowing the best positive review you received on the book and one negative review that got you thinking hard.
Actually, I've got no negative reviews on the book. I'm fine. So, but so the book is primarily about investing uh, and building your personal life. It is not a book about investing in stock markets. It's about actually building your own personal life. So it's about money and its consequences and capabilities to you, and why you should invest, how you should invest in the long term scheme of things, without taking actual, which fund, which this and all that stuff. More of the order of how much uh, you might need in the future. How do you calculate where you want to go? How do you figure out how to build a game plan to get there? And what are the tactics you'll use to actually get to that strategy or implement that strategy for your long-term gains? I think that sums the book up. There is a part of the book called Suckered where I talk about all the scams and shenanigans that have happened. Not all, but some. The issue with the book is, of course, it's too small to have covered everything, but I think it gives you a basic introduction to markets, to finance, to personal finance, and to the concept of how you can start preparing yourself for saving in this new world. So I don't talk about real estate. I don't talk about gold. I'm not interested in those assets. I look at financial assets and I tell people about how they can build their own financial asset portfolio for the long term. The suckered part is primarily to help you understand all the scams that have happened. Honestly, all those scams that have happened there, most of them are repeating themselves in the crypto world. So it's like they didn't read the book, not my book, but hundreds of other books also that have talked about the same thing. But it is the same greed and fear that drives a lot of these things. And as long as you take that away from this process, you will actually, I think, do really well by getting a contextual understanding of the book. It is not for advanced people. It is for beginners, relative beginners in the market. It is for people who might want to. I write in a different style, so it's a little bit, there's a peppering of some humor and some crazy sentences and gyan that I've got from the school of hard knocks rather than from any actual business school. So it's a little different from what maybe more other books might tell you to do. But I think I'm more comfortable with something like that, even writing it and even reading it, than to read a textbook level book. So I want to write a book on the introduction. So that's what it is for. I think I don't remember too many with positive reviews are all like, it's been good. I don't have anything that stands out and says, well, this is fantastic, this has changed my life kind of thing, or I was able to scale Mount Everest because I read this book. वो सब तो नहीं हुआ है. When that happens, I'll figure it out. Somebody takes a photo of the book from top of Mount Everest, that will be like, I have made it. But yeah, negative, of course, most people tell me the same thing. That is, यार इतना basic book है यार. बहुत ही लाइक सिंपल है. व्हाई आर यू नॉट राइटिंग मोर कॉम्प्लिकेटेड. आरबीआई का यील्ड कर्व के बारे में मुझे पता करना था, तो वो उसके लिए और एक बुक आएगा ना, तब देखेंगे. बट दिस इज नॉट फॉर दैट. आरबीआई यील्ड कर्व इज फॉर लाइक very esoteric, very small segment of the population that wants to understand all that stuff. But otherwise, the reviews have by and large been very nice. So thanks to everyone who read the book. I really appreciate that you've taken some time out and read it. In this day and age when everybody wants कि यार podcast में book लगाओ और पढ़ाओ मेरे को. I've got that also. Audible में क्यों नहीं है? Then I mean it's a good point because I only don't read. I don't think I've read the book end to end myself. Because I've read only chapters. No? I wrote chapters, edited chapters, and all that stuff. But end to end, I don't think I've read. But then you can't. It's like listening to yourself speak. It's very boring because you know what you've spoken. So there's no element of surprise. But I'd love to hear anybody's thoughts on how the book is and what their thoughts are as well.
Sure. Thank you so much for being so honest and candid about all this. And so now we'll open up for the audience. I have a few questions. I'll take that up if we get time. Otherwise, Deepak has a hard stop at 2:30. So if anyone has any question, you can just raise your hand so that I can then unmute you so that you can. Yeah. So I see Vikas. Yeah, Vikas, I have unmuted you. You can
Yeah.
ask question.
Hi Deepak, big fan. So it's not just me, my wife, and my 14-year-old son. All of us are big fans. We listen to your podcast, and and both my wife and I have read your book, and we really enjoyed it. The humor was fantastic. So Deepak, I have one question for you. Uh, so my investing strategy is a little different from the way you spoke about, right? Uh, so I I've taken those things of buy and hold too seriously and so on. So I found it very difficult to uh, for, follow whatever you were saying. So my question is like when you have to make a decision to sell, let's say a great company business like Bajaj Finance, and you can see the history of last 10, 15 years. So if you were to sell just because it's going down and buy when it's going up, you will have to get two decisions correct. Uh, Whereas, if you can sort of take a longer term view and say this is a kind of management which is a great track record and the size of the opportunity is so large, so why should I be bothered if it's going down? Don't you think that is a better way to think?
Well, you could say that of airline companies because the size of the opportunity is great. Many managements are fantastic, and yet nothing happens on the stock prices. You could say that of Tata Steel, which is a fantastic company, great market. India uses so much steel. India is the sixth largest producer of steel in the world, and yet Tata Steel's price is roughly the same as 2006, a little bit more. Not even you haven't even earned inflation adjusted returns in Tata Steel since 2006. So you can have long periods of extreme underperformance in stocks when you cannot predict or cannot figure out why a great business also can give you mediocre returns over a very long period of time. If you look at stories in the in the stock market, there is sometimes a reason for you to select a better stock simply because it's a better stock, not because you bought it because it's great management and all that, but there has to be some kind of comparative analysis that says I want to build a portfolio of the stocks that meet my long term criteria. If this stock is great but it's I have a greater stock, then doesn't it make sense to move and sit with the greater stock uh, over time? And that decision, whether you call it a stop loss or whether you call it a churning of your portfolio, it's always a constant part of the process. You cannot avoid it. What you do when you do a buy and hold is typically you sell. You don't add more. You just buy. Uh, and it sits there. But you earn more money every month. So after a few months, you've actually earned a lot more money. You've gone and bought a small portion of one stock. You don't buy any more of it because you don't know why it is that you should buy more of it in the first place. Your problem now becomes that you've bought some stocks, they have a portion in your portfolio, but now you have 15 lakh rupees in stocks and 85 lakh rupees in some debt funds. And for you, that 50,000 rupees in one stock sounds like a lot of money. It's only 0.5% of your overall net worth, but you don't think of it like that. You think of it as, oh, it's 50,000 out of 15 lakhs. That's wrong way to look at things. And you should actually build yourself a philosophy that said it allows me to add on to these stocks over time. Now, whether the stock does well or not is not in your hands. At some point, even buy and hold works, because when you buy and hold, the best stocks will remain, the bad stocks will die. So naturally, you'll get stopped out, right? But if you add to every stock every month, then it's a waste of time. You will actually say, okay, how do you select every month how to add more money? How do I select which stocks to add more money or which stocks to not? That is equivalent to saying sell one and buy the other. If you think of even a buy and hold strategy, if I keep adding to my winners and selling and not adding to my losers, I'm actually making my losers go lower and lower in the overall hierarchy. I may never sell, it's okay. But my winners become 80% or 95% of the portfolio. That's also fine. But you should have a strategy, because otherwise, how do you deploy more money? And most of us are earning money every month. We have the ability to deploy every month. So how do you add more to a stock portfolio unless you have some kind of a strategy that says, I will add more to some stocks, but not to the others?
All right. Thank you, Deepak.
Cheers.
So I have one more. I think Avdut has raised his hand. So Avdut, I have unmuted you. You may ask your question.
Hi, good afternoon. It's really normally it's difficult to attend post-lunch session, but this is filled with humor, so it has been very flowing session in a way. Thanks, Deepak bhai. Just one question about allocation part. You mentioned that you can be like Peter Lynch portfolio holding 1,500 stocks and like Buffett, but the major part is to the allocation. So I would like to know how your allocation strategy has evolved in your portfolio management.
So allocations will change because over time you will figure out what works for you. There are some guys who allocate 30-40% to one stock. That's their wish. As we have decided that we want to be diversified. So we have 30 plus stocks in each portfolio. Each portfolio may have 2 to 3% per at max, maybe 10% per stock, maybe 15%. I think I've gone to more than 10%, but not more than 15%. But allocations from a additional way portfolio is we have a weight that we want to add to every stock. So anytime new money comes in, it goes in the same weight. And that weight also changes according to the stock price. If the stock price goes up, the weight will increase. If the stock price goes down, the weight will decrease. That's the way the system is. So every day I know how much weight I have for every stock. So if I get new money, I will add in that exact same weight. So it doesn't matter to us that, oh, if this stock is too high, I don't like it for whatever reason. And too high is not a problem for momentum, which is one of the strategies we run, but too high may be a problem for a Surge India, which is another portfolio that we run in the PMS. There, I might say, listen, I don't want to buy this stock above this level. Or I might be doing a special situation where above a certain price, it doesn't make sense. That special situation does not happen unless the price is below a certain level. So in that case, what I will do is I will say the weightage of any new additions for this portfolio is 0. That means I'm not going to add any more stocks, any more of this stock, but I will add more of the others. So it will increment the weight of the others in the incremental part of the additional portfolio. This also complicates matters a little bit because we are running more than 800 customer portfolios, which means 800 different people. Some people have multiple strategies. So we have a system. We have written all the tech by ourselves. The tech helps us to figure out how much to allocate to each person. We have just written the tech such that I tell ki, acha, for every day, this is my weights. Unless something has changed, I have to go personally and reduce the weight of any new purchases for that stock, or I may actually decide to sell the stock. This is the decisions a fund manager has to take. The portfolio level allocations happen entirely through a system that we have designed. Luckily, SEBI has said that now all PMSs will need to do the same thing. Otherwise, PMSs earlier could run off Excel sheets and all that. We've done the whole thing ourselves. So for us, moving into the new SEBI regulations we're already there. But At a personal level also, you should have that saying, if I get new money, where am I going to allocate that money? If I have a portfolio, I don't understand much of it, keep it in the same weight as the portfolio. If I understand that I won't want to buy X stock and Y stock, then make the new portions of that portfolio zero, so that you don't add anymore, but you don't sell either. This becomes a hold, and then the rest of it can be added as usual.
And this addition of weight depends on the scheme, like momentum. It will be price goes up, then weight will add, or in that sense. And
Yeah, the philosophy will determine the weights and the stocks to be added.
Understood. Thank you. That's it.
Thank you, Avdu. That was really good question, and I really like the way you. So I didn't know that this kind of strategy you follow, wherein every day you have a different weight, probably, right, based on the movement of the prices. Right?
Because it has to be, no, it's like that. Because if I buy 5 Reliance and 5 TCS, tomorrow the weight may be today 50%. Tomorrow it will be 52-48. Day after tomorrow it will be 57. So it will change according to the weight. But you respect the weight.
Right. So I don't see any more hands being raised, and I think we don't have much time also. It's 14:28 now. So Deepak, one last thing from my side is, what's your advice to me, my team at SmartSync Services, and our Mission Smile family members in investing and in life?
Yeah,
आपको
I
मुझे
think
मालूम है आपको ज्ञान देना अच्छा नहीं लगता, but still you have to say.
but so I'll give you my core things. I think I've given a lot of gyan in this session already. कि क्या करना है, what I think is right now. But I think as long as you guys are continuing to be learners in the markets, there will always be new things to learn, new bridges to cross and things like that. Don't have predefined notions about something. Derivatives are bad, weapons of mass destruction. ये कुछ तो बोलते हैं लोग, and अच्छे लोग बोलते हैं, but what is the point? It doesn't help you, because the same person who says weapon of mass destruction goes and uses derivatives himself. So this funda of please keep your mind open and ready for change, learning, new education, new concepts, new instruments, the ideation, and the fact that there can be opportunities which only you see but nobody else has seen so far. You don't need to be bad, or sorry, you don't need to be phenomenal to discover a new strategy. You can actually stumble upon it by just accident entirely. So most people have that problem. अच्छा इतना अच्छा opportunity होता तो otherwise other people would have seen it. I would say my advice to you is, don't disregard such things. Sometimes you are the first person to see it, and you have seen it from a different angle. Maybe you have seen it best. And that's how opportunities are, whether these are portfolio strategies or stocks or allocation strategies or markets. I mean, Indonesian market is very good. You have found the instrument that invests in the Indonesian market. Nobody else has found it. Maybe that's what it is. The Indonesian market may be the best thing that happens in the next 10 years. How do you know? The question really is, you have to keep your mind open, make it available to process these strategies. And I wish you all the very best, because I think more and more investors that learn about markets, about philosophies, about different techniques of deploying and making money in the financial world, whether it is fixed income or stocks or commodities or forex or whatever it is that helps people make longer term money and build wealth that can help enrich their lives. I think that is important. And to everyone, I'll say this: money is a medium of spending. Whether you like it or not, money's only objective is to be spent. So make money, yes, but spend money. Spend it before you die. Don't spend, I mean, you might not be able to exactly plan it, pinpoint it, but spend, go enjoy yourselves. There are a lot more things than markets. There are a lot more things than money and finance. And you should go and, I don't know, learn skateboarding, do the salsa, climb a mountain, do some skiing, whatever it is that excites you. Don't let it go away because you're too busy making money. So I think that's my overall generic non-financial advice to people, is have fun. So I'll leave it at that.
Thank you so much for giving your time. and we are ending just at the stroke of 2:30 now. And so thank you so much, Deepak, and I'm really happy to have you. And maybe in future also we'll have we'll have a much more deeper interaction, maybe something related to momentum investing, where you can deep dive into how you work. That will also be very helpful for us. Thank you so
Awesome
much,
stuff.
Deepak.
Thanks so much, Ankit. And yeah, I mean, I'm Deepak Shenoy on Twitter. We're at capitalmind.in. So if you guys need anything that I can help with, I'm happy to oblige.
Thank you so much.
Thanks.
Bye.
Take care. Bye.